Markets were in free fall last week, but right now things are kind of calm. Is this the eye of the storm where we're going to get some calm before even more volatility? Or is this it? Is this the bottom? Are we going to get a V-shaped recovery right after this? Chris Vermeulen, chief market strategist at thetechnicaltraders.com, is here to give us the rundown of what we're going to get very soon. Chris, welcome back to the show. Good to see you.
Always a pleasure, David.
Yeah, a couple weeks ago, you were on Big Down Day that day. People can check out the last interview with Chris, link down below. What happened the last week? What's happening right now? Let's just sum up the last 72 hours for folks here. Well, 72 business hours, all the way back to Friday.
Yeah, well, we've seen, this week is kind of just a pause, as you said, a kind of a pause before a storm. I love that scenario because my daughter and I sit on our balcony, we're on the water, and we watch the green skies come in, and things go deadly silent, and then suddenly the fronts hit.
Hmm.
And I feel like that's kind of where we are in the markets. Like a week ago, everybody was completely chaotic. A week ago on Monday, everyone dumped shares. Everyone went from picking a bottom the previous week to then saying, oh my gosh, the market's collapsing, and they all panicked. So more or less everyone got spooked. It's like if somebody jumps out and scares you, your heart surges and all that comes together and you make these emotional moves. That's what happened last week. And this week, everybody's just in pause. They're like kind of digesting, letting the energy kind of surge through their veins. And they're like, okay, I've made my moves. I don't know if they were right. And I don't know which way this market is going. And so today or this week is just like in pause limbo, trying to figure out what is going on.
You told me offline you have a bearish signal. That's important because I don't think your bearish signal was triggered last time you were on. Can you tell us about that? Show us what you mean.
Yeah. So long story short, if we, as a long-term investor, obviously you need to know if we're in a rising tide, a bullish environment or a bearish environment. And if we take a look at the SP 500 weekly chart using the SPY ETF, you can see here we've got after the COVID crash on the left-hand side, we went into a bullish environment. And then in 2012, we put in a major market top. We went into a bearish, and we're just now gone through a very strong bullish environment, and now we've got a bearish environment turning back over. So this is telling us, as a long-term investor, you don't want to be holding stocks in general. When the tide goes down, almost all stocks go down with it. In fact, during a bear market in equities and a economic downturn, almost everything goes down, and sometimes cash is a play, and you want to get out of pretty much most other assets. And what this is telling us is we've had this big flush down low over the past week. It's rebounded. And I believe this is a dead cat bounce or a bear market rally, meaning we're getting this bounce and eventually it will roll over, and we're probably going to go a whole lot lower and see a very big sell off in this equities market. So rallies are being sold into. We're even seeing this on the intraday charts. The previous session, I shared some interesting charts on the 30-minute, how the institutional players are taking advantage of the markets, trying to make people think that this is a buying opportunity and that the market's going to go a whole lot higher. But I believe it is nothing more than a dead cat bounce, and we're going in a downturn. And you and I, David, last time talked about this topping phase over the last several months, how it was almost identical to what was happening in 2011, 2000, or 2022 market top before we started. The only difference this time, David, is this topping phase. It's like the engine is already like blown apart. Every nut and bolt is loose and rattling. And finally, something has fallen off the wagon, and we've had that first leg down. This market condition is very weak. Gold is telling us there's chaos, falling oil pricing telling us that we're going into a recession. So, the market does not look good. It's going to get pretty messy over the next probably 8 to 12 months.
Someone's watching the markets right now and wondering to himself, well, at least I could be wondering to myself, how do you know this is a dead cat bounce? How do you know it's not looking good now? A bounce is a bounce. I'll take it, right?
Yep. Well, it's a good question. I mean, nobody's going to know till it's done, but the scenario that like utilities are holding up, gold is outperforming. We've got the Magnificent Seven, I think, is a very powerful tool right now to follow. If we look at the MAGS ETF, which this is the basket of those, let me just clear this chart. If we take a look at the MAGS, you can see we've got this big breakdown. We had it forming a bullish formation that if we did see it break to the upside, the stock market was going to scream higher for an even bigger move. But instead, it broke down, and now it is underperforming. And we've got this. You could look at this as a huge neckline. There's a head and shoulders pattern which is known as a topping pattern. And so I believe this so-called dead cat bounce that I believe in is going to be a bunch of bars of the market kind of just trading sideways and slightly higher. And then eventually it's going to roll over and break this neckline. And when it breaks the neckline, that is when we see a huge plummet. And wherever the Magnificent Seven go is pretty much where the market is going to drag out. Right now, the charts are showing there are buyers stepping in. There's, people are trying to catch this bottom and play this bounce. But we're seeing on a shorter term basis that the institutional money, the big players, are really messing with people. In fact, I did this update, and I'll show you here last night. More or less, this is a 30-minute chart of the QQQ, and this was the open on the 14th, so the previous trading session. The market opened dramatically higher on the 14th, on Monday. And what the market makers do and the institutions, they try to create liquidity so they can drive the markets up, get people excited, and investors buy into this rally. They feel like, that they want to get in. It creates liquidity in a higher price. And then the institutions can start to sell. Well, there's another tool that I use, which is this FOMO indicator that spikes up when there's manipulation and emotional moves going on. And this move up gets the kind of uneducated, the emotional traders excited to buy into it at the open. And when all that volume surged in on Monday, we saw huge selling take place. If we look at the 10-minute chart, we had big bouts of 10-minute bars of selling into this pressure. And that is the institutions running the market up, getting people emotionally excited and buying in, saying, hey, this market is going to be is strong, buy into this. And then the institutions on the back end are unloading shares into that excitement of the average investor. And the crazy part is, even though this was a very bearish type of day and institutions are dumping their portfolios to get out of stocks, the market still closed positive by like 0.7%. So the average investor sees high volume, positive close. It looks bullish. But when you look at it through layers like this, you're like, okay, this is not strong. These are big players trying to get it higher so they can unload their portfolio. And, these indicators like the FOMO indicator and are things that I teach and I show how to do. And it's really powerful to know the short-term price patterns to help you with the long-term picture as well. And that's what I bring together: short-term, near-term, sentiment, emotions. But it's really powerful stuff. So this is why I believe it's a dead cat bounce, is there's manipulation going on and unloading like this over and over again, day after day in some cases.
Before we continue with the video, let me tell you about the importance of protecting your personal data privacy. Your personal data is constantly being collected, sold, and exposed online. From big breaches to shady data brokers, sites, your private information like your name, address, birthday, phone number, it's all out there. And it's easier to find than you actually think. That's why I recommend today's sponsor, Delete Me. I use it to remove my personal details from hundreds of data broker websites. It's quick to set up, easy to use, and it actually works. Once you submit your info, you'll get a privacy report in about a week showing exactly where your data was found and removed. And it doesn't stop there. Delete Me keeps monitoring these sites year-round to make sure your data doesn't pop back up. Go to joindeleteme.com/DavidLin and use the promo code DavidLin to get 20% off at checkout. Link down below, or scan the QR code here. Take back your privacy today. When you say manipulation, like, what does that mean exactly? How is it being manipulated?
Yeah, manipulation to me is the institutional money trying to create bids and walk the markets up, and they're trying to, get the market higher to manipulate people to think that it's worth buying into this rally. And then it's kind of been walked up. And then as soon as the market opens with all the volume from regular traders, the institutions just start dumping shares and they sell it off. So they kind of manipulate the price up in a way, and then they unload their shares at a higher price. So they have a, bigger profit or a smaller loss because they want to empty their portfolio before this market goes off a cliff. So that's kind of how I
You know what's
that.
another buy and sell signal? Take a look at my screen here. This is from the AP. Trump offers buy tip on social media hours before tariff pause that made stocks soar. This is last week. It's a great time to buy, he wrote on Truth Social.
I saw that. I heard that.
Yeah,
And then, of course, it ripped higher 12%, right?
I mean, like, people were saying, how is this not blatant market manipulation? And
Oh
then
no,
and then and then did you see that? Did you see that clip where he was in the White House and he said he literally pointed to people, Charles Schwab. I think Schwab is in the room. Charles Schwab made $2.5 billion yesterday. That guy made 900 million. And they were just standing there like, no, stop. Stop.
it's crazy. I mean, I think there's a lot of manipulation. Wherever there's money, there's manipulation usually, and you kind of have to turn a blind eye. We know it's going to happen. It happens every day, and you just have to manage your own positions and not feel like you're missing out or getting screwed. Because the markets have always had that kind of stuff going on. But there's no doubt him saying like it's a buying opportunity, and then the biggest rally ever, 12% in the Nasdaq in one day. It's like somebody made a fortune.
Well, people who listen to him did. Now we just have to like, he's like he's giving us the best trade. We just have to listen to his tweets. All right, Chris, let's take a look at the S&P one more time, please. And
Sure.
let's just evaluate this breakdown that we've gotten ever since the beginning of the year. First of all, we're in official bear market territory currently, correct or wrong?
Correct.
Okay. What does that mean going forward? When we're in a bear market, um, do we start to position ourselves for longs? Wait, that doesn't sound right. When we're in the middle of a bear market, we should probably prepare ourselves for shorts. But um, people will wonder, well, what about bounces? Shouldn't we be loading up on longs along the way? Shouldn't we be prepared for, some sort of recovery, a bounce? Um, how do you evaluate that kind of statement?
Yeah, so I would say like this is going back to the 2000, this is the SP 500 weekly chart, going back to the 2000, market top. We got the 2008 market top. When we enter a bear market or a stage four decline, usually you see a big move to the downside, it does damage, and then it has a bounce. And sometimes when you're in a downtrend, the odds are it's going lower. And if you look at this kind of price action, it really just traded sideways for several months. It actually didn't have this strong rebound. Sometimes you do get these strong rebounds. We saw the same over here. It started a rebound in 2008, a big 1 week bounce, which is exactly what we just saw. And then it went and actually made some lower lows over the next month, and then it put in a bigger bounce. The key is, even the bigger bounce isn't much higher than where, that big 1 week rally is, similar to where we are today. So there's very limited upside. It's not about trying to catch a bounce and play the rally or the bounce. It's about letting it shake itself out and then finally put in a true multi-week, multi-month bounce. And then when it starts to roll over, that is when you're like, okay, now we short sell or buy an inverse ETF on the markets or move to a different asset class in general and let the market fall and benefit from that. So don't play the bounce, even though everybody wants to, because it might not bounce much. You're better to let it work itself up. And when it rolls over, expect it's going to make multi legs to the downside. And that's what we saw in the 2020 2000 tech bubble. There's more times that the bars are down in red than they are up. So trade with the tide. If it's down, focus on it, letting it bounce. Be patient. That's the hardest thing for most people involved in the markets. They want action, they want to catch every move. Just let it bounce, let it hit resistance, let it start to roll over, and then get excited and then take position for a move to the downside. So that is like what happens in a bear market. And it's not about playing the upside, it's about playing the downside. So ignore any bounce and just know the higher the bounce is, the more opportunity it has to the downside later.
Okay, so we're in the middle of a bear market. It's down about 20% from the top in late December, year to date, I think, roughly. So, what's the downside target for you? You spoke to me last time about potentially a 50% with a down draw from the top. Is that still in the cards?
Yeah, so there's a few levels we can look at. So just based off the COVID lows, which is a very standout, significant low where the market has hit multiple levels, we could see it pull back to about 4,600 all the way down to about 4,100. So in the reality from the ultimate highs, we're looking at about a 25 to roughly 30% pullback. Now that's just based off the COVID fuel to the fire and all that stuff that took place in the AI kind of squeeze and bubble there. But if we actually go back to potentially like even the more significant low here, this is obviously an extreme measure. of where price could go. This tells us where we could see this market pull back. I'll just get rid of this other one. We could see the SP 500 pull back anywhere from about 34% all the way down to about 45 or even that 55% range. And I mean, this is a big pullback, but it's very similar to what we saw back in the tech bubble burst, the financial crisis burst. We're going to have something else burst, whatever it'll be this time. But there is a lot of downside, and this is the sweet spot. Whoops, this range is the sweet spot, and the market is always gunning to make higher highs or lower lows and run the stops. And if we take a look at this significant low from 2022, if the market does get down here, it is going to want to break that low and run the stops and create massive panic sell off, which could create a huge initial drop that brings us right into the middle of this range. We had a huge megaphone pattern happening back over here. There's a lot of volume through here. That would be a very key support level after breaking a very significant pivot. So, there is that 55% pullback, and I believe it's very possible with what's going on. So, and if this happens, we're going to see most other assets fall apart. We've got real estate that's looking really weak. I just read a thing that 90% of homes owned in Arizona are Canadians. And I mean, Canadians are on a tear. They feel threatened from, becoming a state, and nobody likes to be threatened. And so we're seeing mass home selling. We're going to see even more in Arizona, Florida. We've got millions of snowbirds, of people that go down for the winter and own homes for 6 months in Florida. We're going to see mass liquidation across all kinds of stuff. And so real estate's going to be weak. I think precious metals, even though they're on fire right now, I think they're going to get hit. They're going to sell off. And we saw that. We saw panic selling last a week and a half ago in the stock market. And what happened? Gold fell like 8%, just like that. When there is mass panic, people liquidate even the best positions because they don't know, they're emotional driven, and they just want to ease their pain. So 55% correction, I think, is very possible, and a lot of stuff's going to pull back with it. It's going to be, depending who you're talking to, like even Peter Schiff, great point of view. I mean, it's like going to be a depression. It's going to be really difficult times, and yeah, it's going to be a good scenario for opportunities to profit from falling pricing, but then also to reload and reinvest when things are actually probably a fair value or like way below market value.
Okay, we're gonna come back to real estate in hard times just a bit. When you say all assets are going to be taken down by this, do you mean all assets? There's no safety we can go?
Well, there'll be something that goes up. Maybe bonds start to rally if they start cutting interest rates. Obviously we're in very unique times. If inflation is here to stay and it's going to spike up with what's going on, the Feds should be raising rates to help counter that, but they're probably going to cut rates because the U.S. is struggling in a big way in terms of higher rates is going to really dampen things. So if they cut rates, bonds could become a favorable play. The US dollar is really tough. Typically, we see the dollar move up during mass chaos. Maybe we will see that again, but right now it's definitely under pressure with tariffs, and it's doing a lot of damage to the chart of it. So I'm not sure where the actual safe haven play is going to be, other than temporarily move to cash and potentially inverse ETFs, meaning as the market falls, you're owning something that goes up. Sometimes the best play is actually just, bet against the market. If it's falling, let's bet on it falling. That might be one of the only plays temporarily going forward.
Let's take a look at the dollar chart now. DXY. Not a good place to be right now, currently. And it's just, yeah, people have been talking to me on my show in particular about dumping the dollar, foreign countries dumping the dollar, foreign investors, even Kashkari, Minneapolis Fed Kashkari was talking about foreign investors showing signs of leaving the U.S., capital outflows. Perhaps that's reflected in the dollar right now. Can we just take a look at what's been happening in the last 3 months?
Yeah, sure. Let me pull up the last 3 months. Obviously, it's been a lot of selling pressure in the dollar. If we look into it the last 3 months, and as soon as the whole talk with tariffs kicked in, the dollar started to fall in a pretty dramatic way. We are definitely down into this lower support zone, where in this lower range where it's trying to find some support. The only thing that I find a couple things bullish about this. I do feel like the dollar is in the US is still a very somewhat strong country, that when chaos hits, I mean, those with the biggest guns and missiles, tend to do really well. The dollar seems to recover. The US is very resilient. It's amazing how it can bounce back. So this move down on the dollar is obviously news driven, and things that are driven by news are usually given back later. So there's been this huge slide, and I think now we're at major support. It's kind of pierced some levels. I think it's starting to see a little bit of a flush out in terms of it might be trying to put in a bottom here and bounce. Obviously, there's a lot of damage. We need to see how it bounces. If the dollar struggles and maybe just trades sideways like a bear flag, then it's actually going to be pointing to another huge collapse in the dollar price. So this is very critical where we go. When something drops really fast to a support level, especially on news, you just have to let that news work itself out, and then hopefully we see some type of bounce. Because I do believe the dollar could potentially move higher. In the long-term picture, if we take a look at the monthly chart, the dollar's still in this bullish phase. Obviously, we've gone from a major top after the 2000 tech bubble where the dollar did well. We sold off. The dollar's put in this major bottom, and now it is a series of higher lows and higher highs of these big channels. So the next few weeks are going to be very critical for the dollar. Is it going to hold? Is it going to break down? Obviously, there's a massive bearish story on the dollar potentially really reversing, but it seems everyone is bearish on the dollar. It's news driven, and usually that's a sign that things are going to reverse. And it's kind of the opposite with gold. Everybody's super bullish on gold. It's going to the moon and back, and everybody says the dollar is going to worthless. Usually those extreme emotions happen, near a turning point. So that's kind of my outlook. We need to see right now the dollar's at support. It's got to hold it, or it could get really ugly.
What are you doing right now with your trades?
We moved to cash a little while ago. If we look at the overall markets, this is the QQQ. We moved to cash a month and a half ago. We saw the market, it had a beautiful run up, started to give us some false signals, and then everything kind of fell apart. We moved to cash, and we're just sitting here just collecting monthly interest and dividend payments in a BIL ETF as the market kind of shakes itself out. We need to see how this is going to play out before we take action again. And right now, kind of cash is, other than gold moving up, cash has been a very good play. And I think we just need to see how this market kind of rolls over and how it's going to play out over the next couple of weeks. Because the next leg down, there could be an opportunity. Who knows? The dollar might actually provide a bottom. There could be an inverse ETF trade as this unfolds and goes down. We'll just have to wait and see. But right now, we're just kind of on the sidelines, just kind of absorbing, learning, picking up on the bias of the markets and watching the technicals, which are very mixed. There is no clear signal right now, other than the long-term trend has come to an end and is now pointing to lower pricing.
Let's take a look at gold. Gold is an asset that's been ripping higher. We talked about gold a while ago, and you had told me that it was overbought. That was about $100 ago. Now it's 300 or 3,200 something.
Yep.
Is it still overbought, or have you changed your mind?
Yeah. So long story short, I do believe it's still overbought. It doesn't mean you're short it. It doesn't mean you sell it and get out of it. It just means the trend is up and it's ready for a pause or pullback. Using Fibonacci extension, we have these key targets, and going all the way back to early 2000, even going to the 2015 lows and the rally, we have two levels here hitting the same spot, David, which is that 2,800 range where gold has hit. Now, based on this 20-year and kind of 10-year cycle, uh, the move has been done. We've had this big bullish breakout in 2019. Now we've hit that, and now we're in this what I just kind of call a blow off phase or icing on the cake. All this move now here to me is kind of extra. We're in a sweet spot where the stock market, I believe, is stalling out. The economy is stalling out. That is the sweet spot for gold to take the lead, and everybody's starting to get very excited about gold and pile in and drive it higher. We see these blow off phases typically happen each time just before a major market kind of reset. In 2008, we saw a 34% pullback. We saw 2011 top in place. And so I do believe we're going to see some type of pullback and pause when we enter a recession. But right now, it's in this no man's land. My next target is 3,275. We've pretty much hit that.
Yeah.
And so what we need now is gold to trade sideways or have a bit of a pullback. Once
Right.
it does that, then we can gauge the next leg higher. But right now the legs are small because even the biggest 20-year kind of chart pattern has already maxed out in terms of where it's going to go. So we just have to inch our way up, follow price. And if it starts to roll over, then you got to be aware that if it is a trade, then you might want to like move out of it, lock in the gains, and be prepared to pick it up later. But
But
we're definitely seeing a spike in the gold silver ratio. It jumped like 10% last week. Last time, the previous times it's jumped like 10%. We've seen huge market resets happen.
yeah.
So there's a lot of fear going on.
I'm not long or short gold one way or the other, but I'm just pointing out something interesting. The fact that gold moved up while stocks have been moving down in the past couple of weeks, does that not signal to you that gold is now the safe haven asset play?
Yeah, oh, for sure. It's the safe haven play, and you and I have looked at it. We're in this sweet spot in terms of these cycles of the market where gold is the most powerful play. It does well and it continues to push higher while the stock market goes down. We saw this in 2008. The equities went down for several months, gold went up for several months, and then the chaos kind of hits. And that's exactly what we're setting up for now, is the same scenario. We're setting up for a stage 4 decline. The stock market more or less has had a big pullback, and I believe we're going to go lower. But what you said is totally true. It is the safe haven play right now, but now it's in nosebleed territory, and I don't like to buy things when they feel like they're somewhat overbought. They're the crowded play. Everybody's talking gold and wants gold, and everybody's saying the dollar is going to zero. I'm not a fan of buying an emotional, rally into emotional rally. I already own physical gold long term. I'll pick it up after it trades sideways for several months and builds a launch pad before it goes higher, or I'll pick it up after it pulls back. But I don't like to buy into kind of screaming rallies when it's, 20 bucks away from 100% measured move target, where it's going to run into some selling pressure most likely.
By the way, I just want to point something out, and I want to finish off on Bitcoin. But before that, you were on the show, well, I mean, every couple of weeks, but back in January, you were calling for a 25% crash. You pretty much nailed that, right? Because that's what happened in the subsequent 2 months. So good job there. I I'm just trying to get a sense of how much further we can go down from here. So if I were to, I'm not going to, but if I were to tell people, look, Chris told us we're going to go down 25% in January. He was right. It's now middle of April. We're going to go down X percentage. What is that X?
Um, I don't think we're going to go down in April. I do think the market is set to bounce
Okay.
for a few weeks, but I do think maybe the sell in May and go away will come into play. So we'll
Okay.
have that bounce into May, and then maybe sellers kick in. Um, I don't know how far we're going to go in the next leg down.
Sure.
It's really tough to gauge. I do think if I take a look at let's look at the daily chart. We might be able to grab a price pattern here. So if we were to look at the next potential move down, we could kind of just base it off of this drop and this bounce, and this will tell us where the next potential move. Now, I'm not a fan of this chart pattern to draw this out, but it is saying from where price is right now on the SP 500, we could drop about 16%. That would be the next pivot low on the chart, and that's what the Fibonacci and the short-term technicals right now are pointing to. With that said, the caveat is I do believe it's popped and it's putting in a little pattern here, and it is going to try and push higher. So as if it does, that we have to reanalyze and recalculate. But there could be a 16% drop over the next couple of weeks. To be honest, that's what happened in 2008. It actually would reverse like right now and hit those new lower lows, and then put in a multi-month bounce. So it's this is why we're on the sidelines. There are massive mixed signals. And when there's mixed signals, I like to keep my money, not ride a roller coaster. I just sit on the sidelines and observe.
Mhm. All right. I got it. Bitcoin now. Let's end on Bitcoin. So a lot of volatility for Bitcoin as well. It's mostly been following, mostly, I say mostly because it hasn't been 100%, but it's mostly been following stocks. We're at just under $85,000 now, Chris. You told me a while ago 108, I think 112,000 was the top for you. Um,
Mhm.
how far are we from that kind of a level now that this kind of volatility is in play? Are we going to see that again this year, you think?
I don't think so. I think, we had that really nice breakout in Bitcoin hitting our target and hitting our 108 target here. And then it's put in this double top. And then it's put in this breakdown. It has a series of bear flags. and it's trying to carve out a bit of a bottom. Now, if the stock market does bounce over the next week or so and go a little bit higher, we're probably going to see Bitcoin come back up to this level, probably this 94 or 90,000, 92, 3,000 area. It's going to come up underneath this resistance area. This is going to act as a resistance zone. So if stocks bounce and the Nasdaq bounce, I would expect Bitcoin to bounce. But overall, I mean, I do believe my next kind of downside target is about 72,000. Um, and then from there we'll just have to gauge it. But it's really hard to get a read on Bitcoin right now. The trend is down. I would follow the stock market to get an idea of what Bitcoin is doing. If the stock market starts to run and rally, then Bitcoin will probably move the same. But Bitcoin has got a series of lower highs, lower lows, just like the stock market, and it's not something you want to buy. I would say the next downside is 72,000. That's more likely than anything else.
Yeah. Great. Well, Chris, I want to come back on real estate and the hard times you're telling us about. Real estate is an asset class that affects us all. Tell us the interplay. Well, tell us about the interplay between stocks, capital markets, and real estate. I mean, just because the S&P 500 is falling, it doesn't mean our home values will decline, right?
Um, right. They are disconnected. They're a totally different asset class. But I think there's a bigger thing at play, especially when it comes to potentially United States real estate. I mean, I'm in Canada, so are you, and I'm embedded in with a lot of snowbirds, and almost everybody I know goes to Florida or Arizona for the winter, and they all have homes, and they all owned homes there for a decade or two. So I think if the stock market starts to go down, it starts to spook people, and the real estate market has gotten soft. People are upset with what's going on in the States. The Canadians are, they feel threatened. And so a lot of them are talking about and already starting to sell their homes. So that's going to create a selling pressure. And I already believe there's tons of surplus homes for sale. Things aren't actually selling in most places, especially southern United States. When home prices, I think, start to sell at a lower price later this year, this spring, I think we're going to people are going to realize in order to sell your home, you have to lower the price more. As you were saying, like real estate, most investors own real estate, whether it's your own house or a bunch of rental properties. When real estate starts going down and the stock market is going down together, it's like a double whammy punch that all your assets, your biggest assets are going down. So people get nervous, and I think there's a lot of uncertainty in the States. So I believe the US is going to have a lot of pressure in real estate and drop fairly significantly simply from millions of homes coming on the market from Canadians and the increases of uncertainty and just the economic stage that we're in. Even if interest rates go down, I don't think it's going to save the housing market. There's these giant cycles at play that are beyond what the Fed can do. I mean, most bear markets, the Fed is just slashing rates, trying to save things. It helps for a short-term bounce, but I think we're in just an overall cycle in the economy and what's going around globally that, just like a tide going up and down, you can't really stop it. You might be able to delay it a little bit, but I think we're going to see home prices go down along with stocks and everything else going forward. So it's going to be difficult because, most people's biggest assets, their homes and stock positions are going to lose value, I think, fairly dramatically.
Right, but interest rates are going to probably not probably, but are expected to go down. In theory, that should also bring down mortgage rates. Wouldn't that, you know, wouldn't that spur some more demand?
It would, but we usually see like the lowest interest rates kind of after, when the real estate market is finally fully bottomed. The thing is, when people are scared, they don't want to buy things. That they just clam up and they
Mm.
just shut down. They're like, I'm not buying anything until I feel certainty, comfortable. And so it doesn't matter if rates keep falling. Yes, it should help some of those people who are itching to buy and get into real estate, being like, you know what, it's kind of feasible now to buy this property. It will help. It will help stabilize things a little bit. But when there is mass chaos and scared investors, they don't go spending large amounts of money. They really wait until things have turned a corner. And usually investors are late to get out and then they're late to get in. So again, no matter what happens with the rates might help slow the price drop and support it a bit, but people just aren't going to be in a buying mode. And that's the part of a recession and kind of a depression is people don't want to spend money. They want to preserve it. They're scared of using it and losing it. And so home prices and stock prices, can keep coming down and people just keep stashing cash kind of hoarding it to protect themselves.
So what you're actually saying is this is a buyer's market right now.
No, I don't. I don't think it's a buyer's market. I think the market is about to drop. I think we're going to see home prices drop another 15 to 20%
Okay.
on average across the board. Then it's a buying
Okay.
opportunity.
I see. Well, what needs to happen to the economy for people to start feeling more confident, to start wanting to buy things again?
I think the market still needs to go lower. I think home prices haven't really collapsed. They've come off their highs, but they haven't had a drop that things are even really feasible yet. You can't just go buy a house and to flip it and rent it. It's going to cost you money. So things are still overvalued. I think when it becomes feasible, when there's tons of homes and stocks are really cheap and the PE ratios are in line and you can pick the house you want. You're not forced to, you got three homes to pick from and none of them are perfect, but you need one. It's when there's like 100 homes in your area, you're like, oh man, there's so many to pick from. I don't know which one I want. That's when it's a buying opportunity. But until you're really flooded and we have that next drop in pricing, I think you just need to hold off and wait. It's tough. I mean, I grew up around real estate. My dad had 1,600 doors at one point, so I get a good feel, understand how it works. There is a feel and energy that you'll pick up. It's just like I speak to traders and investors every day. I know what they're thinking and feeling, which gives me a good idea of where the markets are at and what they're doing today and all that stuff. So you really do have to live through the experience to be like, okay, I see it, I can feel it, the vibe is changing. And usually, people will be really scared of real estate. And that's actually when you need to move into it, is when things look really bleak.
Okay. Well, let's follow up more. Perhaps there's some good news on the horizon. We'll see. Chris, thanks for coming on the show today. Good to see you as always. Where can we follow your work?
Yeah, they can follow me on YouTube at The Technical Traders or my website, thetechnicaltraders.com. And I share videos like this every morning, usually before the opening bell. And you just copy my trades. I share my ETF trades, what I do with my portfolio. And that's what I share through my newsletter. So you can just ride my coattails. I do the work and you can just follow along.
Okay. Good stuff. We'll put the link down below, so make sure to check out Chris's work. I'll put the link there. See you next time, Chris.
Thanks, David. Always a pleasure.
Thank you for watching. Don't forget to like and subscribe.